My belief is that after 3 years or 4 years or 5 years, people will begin to understand the price that they pay for the diminishment of the purchasing power of the dollars that they earn working or in their savings. I suspect that you'll look at the CPI, which suggests that, quote, inflation is moderate at 2.6%. But you'll look at what happens to the basket of goods and services that you purchase that impacts your lifestyle. And you'll say, wait a minute. The purchasing power of my dollars isn't decreasing by 2%. It's decreasing by 7% or 8%. And if you experience that over 5 years, if you watch your rent, as an example, if you were a renter, increase by 6 or 7% compounded. If you watch the cost of a shopping basket full of groceries increase by 100% over 4 years, all of a sudden you come to the same conclusion that retail investors came to in 1972 and 1973, which is to say all is not well. And I think it's that consciousness that really kicks off a market in the metal. And let's talk about one other thing while we're at it, which is to say the probability of increases in the future. I don't want to give you a Canadian number because I don't know it. But in the U.S., the on-balance sheet liabilities of our government exceed $34 trillion. The off-balance sheet liabilities, though, Medicare, Medicaid, Social Security Trust Fund, military pensions, government pensions, all that kind of stuff, exceed, according to the Congressional Budget Office, $100 trillion. And we propose to meet these obligations with a budget that goes further into deficit by $1 trillion every 100 days. Now, how do we get ourselves out of this conundrum? Understanding that America's GDP is under $30 trillion, which is to say our GDP is less than our on-balance sheet liabilities and is 20% of a combination of our on-balance sheet and off-balance sheet liabilities. How do we solve this? Well, they say, tax the rich. Top 1% of Americans have an aggregate net worth of $5.8 trillion. If you stole the entire net worth of the 1% in the United States, you wouldn't have solved the debt. What you would have done is funded, something like 20 months of the deficit. How about curtailing benefits? Let's say to the old guys like me, hey, Rick, you voted yourself a whole bunch of cool benefits for 40 years. You forgot to pay for them. We're not going to give you the money. You follow me? There's a whole bunch of hard choices. And you know what? We faced those hard choices before. Not as hard, but we faced them in the decade of the 70s. We had unsustainably high debts. We couldn't raise taxes. So what did we do? We inflated away the real value of the obligations. The purchasing power of the US dollar over the decade of the 70s declined by 80%. So we didn't renounce the debt in the honest, old-fashioned way by saying, yeah, we owe, but we ain't going to pay. Too bad, too sad. What we did is we made the debt less important relative to the inflated dollars that we took in via taxation. So my suspicion is that the way that we deal with this $130 trillion obligation or series of obligations is that we, in effect, inflate away most of the present value of the obligation.
My belief is that after 3, 4, or 5 years, people will begin to understand the price they pay for the diminishment of the purchasing power of the dollars they earn working or in their savings. The Consumer Price Index, CPI, suggests that inflation is moderate at 2.6%. But when you look at the basket of goods and services you purchase impacting your lifestyle, you realize the true picture. You'll say, wait a minute. The purchasing power of my dollars isn't decreasing by 2%. It's decreasing by 7% or 8%. If you experience this over 5 years, watching your rent increase by 6% or 7% compounded, or the cost of a basket of groceries double over 4 years, you will come to the same conclusion that retail investors did in 1972 and 1973. All is not well. This consciousness really kicks off a market in the metals. The probability of increases in the future is significant. In the U.S., the on-balance sheet liabilities of our government exceed $34 trillion. The off-balance sheet liabilities, Medicare, Medicaid, Social Security Trust Funds, military pensions, government pensions, and more, exceed $100 trillion according to the Congressional Budget Office. We propose to meet these obligations with a budget that goes further into deficit by $1 trillion every 100 days. Our GDP is under $30 trillion, less than our on-balance sheet liabilities, and just 20% of the total liabilities. How do we get out of this conundrum? The idea of taxing the rich doesn't suffice. The top 1% of Americans have an aggregate net worth of $5.8 trillion. Even if we confiscated their entire net worth, we wouldn't solve the debt problem. We'd only fund about 20 months of the deficit. Curtailing benefits is another option. Imagine telling retirees that the benefits they voted for themselves over the past 40 years won't be paid because they forgot to fund them. These are hard choices we faced before, though not as hard in the 1970s. Back then, we had unsustainably high debts and couldn't raise taxes. We inflated away the real value of our obligations. The purchasing power of the US dollar declined by 80% over the decade. Instead of renouncing the debt outright, we made the debt less significant relative to the inflated dollars taken in via taxation. My suspicion is that we'll deal with today's $130 trillion in obligations by inflating away most of the present value of the obligations. Two main factors contribute to this scenario. First is the weaponization of the US dollar. The US government has decided to export its policies to other countries through the SWIFT banking system and other mechanisms. This has caused countries like Russia, China, India, and Saudi Arabia to question their holdings of US Treasury securities and their use of the US dollar for international trade. Second, the arithmetic around US Treasuries has deteriorated. From 1982 to 2022, the internationalization of the US dollar and the decline in both nominal and real interest rates were tailwinds for gold. Now, foreign countries see US Treasuries as instruments that pay a modest 4.3% to 4.5%, while the purchasing power of the dollar declines by 7% or 8% compounded. This negative real rate of return, combined with the extraterritorial imposition of US policies, makes treasuries an unattractive investment. No wonder countries like China have reduced their holdings of US treasuries by about 70% over the last 5 or 6 years. They find better returns investing in their own economy and in their Belt and Road Initiative projects around the world. This shift also helps them avoid the risks associated with US policies. Consequently, foreign holdings of gold have increased, while holdings of US treasuries have decreased.
I think it comes to two general things. First is the weaponization of the US dollar. The US government has decided, in their wisdom, by the way, whether or not you agree with US policy, to export US policy to other countries who may have their own agendas. The weaponization of the SWIFT banking system, which is not US property, but the US government has decided to do anyway as a consequence of the fact that it's denominated in US dollars. And further, the theft by the US government of $300 billion worth of Russian holdings of US treasuries. Again, whether or not you agree with Russia's policy or America's reasons to do so, has caused governments around the world who believe that they might come into the sights of the US government. As an example, the Russians, the Chinese, the Indians, the Saudis, to question their holdings of U.S. Treasury securities and their use of the U.S. dollar for international trade. A second problem, I think, is that the arithmetic around U.S. Treasuries has gotten worse and worse and worse. We came through a period really of U.S. dollar hegemony. I would suggest in the period 1982 to 2022, the internationalization of the U.S. dollar and the decline in both nominal and real interest rates were tailwinds for gold. Now, I think that foreign countries in particular that look at the U.S. dollar and look at U.S. treasuries see an instrument which pays them 4.5%, I'm talking about the U.S. 10-year, in a currency where, separate and apart from the CPI, they see the purchasing power of the currency decline by 7 or 8% compounded. And so they're stuck with this sort of a conundrum. You invest in an instrument which gives you a negative real rate of return, and you do so while exposing yourself to the risk of the extraterritoriality of U.S. policy. It's a real lousy bargain for those countries. It can't be any surprise that the Chinese, as an example, have reduced their holdings of U.S. treasuries by about 70%, over the last 5 or 6 years. In the first instance, they think that investing in their own economy and in their Belt and Road strategy around the world yields higher real rates of return than they would if they were invested in U.S. Treasury securities. And they also allow themselves to escape, at least in some sense, the extraterritorial imposition of U.S. policy through the U.S. dollar. So it's no particular mystery as to why foreign holdings of gold have increased and foreign holdings of U.S. treasuries have decreased.
Well, that's what central banks are doing now. You made mention of the fact that investors, both institutional and retail investors, are not participating in the purchase of gold or gold equities. Why?
In the last 5 weeks, my evidence comes from the ETF holdings. They have begun to participate. Why they didn't participate before is a matter of conjecture. My conjecture would be that gold is an instrument that reacts to fear. And we've lived through 40 pretty benign years, going back to the beginning of the lowering of the U.S. interest rate in 1992, all the way through 2022. Stock market was up, the bond market was up, there was lots of liquidity. I'm not trying to say there weren't some punctuations, 1987, 2008, we had some pretty dramatic punctuations, but the lessons that we learned as investors in those punctuations were that you'd buy the dips. The truth is that people were pretty optimistic because financial markets were continuing to do well. This reminds me a bit, frankly, of the late 60s and early 70s, when all of the indications of inflation were in the system, but people hadn't experienced it yet. They'd lived through 2 benign decades after the end of World War II. And while people read about inflation, it wasn't till they had sort of 5 years of experience with inflation. It wasn't until they'd seen the price of gas at the pump go from 20 cents a gallon to $1 a gallon, as an example, that they began to internalize the lessons. And I believe that the same process is underway right now.
This shift is also evident in the behavior of central banks. They've been accumulating gold at an unprecedented rate, and it's not just for diversification. It's a strategic move to hedge against the volatility and risks associated with holding U.S. dollars in treasuries. This trend is likely to continue as more countries seek alternatives to the dollar. For retail investors, understanding this shift is crucial. Gold and silver are not just hedges against inflation. They are strategic assets that provide stability in a volatile economic environment. The recent trends in central bank behavior, coupled with the macroeconomic indicators, suggest that the value of these metals will continue to rise. Let's not forget the lessons from the late 60s and early 70s. Inflation was in the system, but people hadn't experienced it yet. It wasn't until they saw the price of gas go from 20 cents a gallon to $1 a gallon that they began to internalize the lessons. Similarly, we are in a period where the indicators are there, but the full impact hasn't been felt yet. The on-balance sheet and off-balance sheet liabilities of the U.S. government are staggering. The Congressional Budget Office's projections are alarming. With GDP under $30 trillion and liabilities far exceeding that, the path forward involves tough choices. Taxing the rich or cutting benefits alone won't solve the problem. The likely outcome is inflation, which will reduce the real value of these obligations over time. This brings us to the importance of gold and silver. These metals have historically provided a hedge against inflation and economic instability. As more countries move away from the dollar and seek alternatives, the demand for gold and silver will rise. This is not just about protecting wealth. It's about understanding the broader economic shifts and positioning oneself accordingly. Investors need to be proactive. The trends are clear: increasing debt, decreasing purchasing power, and a shift away from the dollar. Gold and silver offer a way to protect against these risks. The historical performance of these metals, coupled with the current macroeconomic environment, makes them a compelling investment. For those who still doubt the potential of gold and silver, consider this. Bank of America is calling for $3,000 an ounce gold in the next 12 to 18 months. If we apply the historical gold-silver ratio, That puts silver at approximately $71 per ounce. This projection is not far-fetched when you look at the global trends and the strategic moves by central banks. China, for instance, has been quietly accumulating gold. The true extent of their holdings is likely much higher than reported. Chinese banks are buying gold on behalf of the People's Bank of China, and this accumulation is not reported to the IMF. This strategic move is mirrored by other countries as well. India, for example, has significantly increased its gold purchases and repatriated 100 metric tons from the Bank of England. The repatriation of gold by countries like Saudi Arabia and Egypt from the New York Fed further underscores the loss of trust in the U.S. financial system. This move to reduce counterparty risk is significant. It highlights the strategic importance of gold and silver in the current economic environment. As Zoltan Pozsar notes, this shift is about commodities. The broken trust in the system is driving countries to accumulate tangible assets like gold. This trend is likely to continue as more countries seek to protect themselves from the volatility and risks associated with fiat currencies. For individual investors, the lesson is clear. Diversifying into physical gold and silver is not just a hedge against inflation. It's a strategic move to protect against broader economic risks. The actions of central banks and the macroeconomic trends provide a clear roadmap. Following this roadmap can help investors safeguard their wealth and ensure long-term financial stability. For our American and allied viewers, the strategic accumulation of gold by central banks worldwide should be a wake-up call. The diminishing trust in the U.S. financial system and the increasing debt obligations pose significant risks. Diversifying into physical gold and silver can provide a hedge against these risks and offer long-term financial security. This strategy is not just about preserving value, but ensuring stability in an uncertain world. Stay informed, diversify your portfolio, and safeguard your wealth with strategic investments in precious metals. Understanding these global shifts and positioning yourself accordingly is crucial for protecting your financial future. If you want to stay most up-to-date on the silver and gold markets, make sure to subscribe to my daily 5-minute silver and gold newsletter. It provides the latest expert insights, breaking news, market trends, and investment strategies, all in a concise format. Click the first link in the description to join thousands of others and enhance your investment knowledge right now. If you enjoyed this video, please give it a thumbs up and subscribe to my channel. Your support helps me stay motivated to bring more valuable content to you. See you in the next video.